Okay, so I wanted to elaborate a bit more on what we saw yesterday during the FOMC meeting. At the top of this month of March, I called this March Madness, not also because of basketball, the brackets, but yet and still, we saw the February CPI report showing that inflation is literally 8%. Let's just go ahead and call it what it is. But also, we seen yesterday the first of 5 to 7 tax hikes. Yeah, so we're still seeing supply chain issues. We're still seeing other things at bay happening. So it's a perfect storm. Get it? March Madness. So I wanted to give some context into some things, no matter if you're an investor or a consumer, that you should potentially pay attention to. And I have this kind of framework that I talk to my clients about called the 3A method, which is audit, align, and accumulate. And it actually applies to no matter where you are within your personal finance journey or what topics that we're talking about. So it does apply to this situation that we're seeing now with the federal interest rates and how this one of many tax hikes that we're going to witness could impact you no matter if you're a investor or a consumer, which technically you might fall into both silos. So on the investor side, audit your holdings to know how they're doing within the diversification. It all just understanding where your positioning is. Positioning is going to be a big word for investors this year, not necessarily just for federal or for this situation that we're seeing right now, but also when we're seeing with the pandemic still pandemicking, the inflation still going on, but just period. As investors, it's very key for you to really hone in on how things are doing with positioning. You can be a long holder. If you're a crypto, you understand what holding on for dear life means. You can also do that when it comes to your investments and when it comes to stock market. But the thing of it is understanding what things are doing, how they're positioning, and how they are within your portfolio. So I always say for you to check your portfolio holdings and the positioning to understand how to maneuver. Yes, you can still hold those things, but you can also change the position if they're not performing well. So yes, you can. It's key to hold those things, but it's key to hold those things, but it's very key to understand to know how to move them or even to move them out. Going over to align. It's some other things I want people to pay attention to is that due to this federal tax hikes, some entities such as banks, insurance companies, DeFi, REITs, and other things are going to benefit heavily. Why? Because you'll see when I talk to the consumer side of this situation, they're going to see a boost in potentially revenue. You're going to see their earnings reports look a little bit differently in a good way and things of that nature. And over to the next A, accumulate. Look for ways to see gains during this volatility. And that's another thing I kind of want to give leeway to is that we're potentially going to see some volatility. At the end of the FOMC, some entities within the stock market was performing well. China stock actually performed well, which interestingly enough, during situations like this, we see them actually tank. So during the end of the FOMC, we actually seen them perform well, and other pockets of stock actually were doing well comparison to at the top of the opening yesterday. Going over to the consumer side of the 3A framework, audit. Understand the interest bearing accounts that you have. And this is going to change due to this federal interest rate start to move up, because you're going to see the cost of buying a car due to the loans, buying a house due to mortgage rates, and certain things such as your grabbing loans on certain things going to change, because this is going to make that percentages go up, which is going to change the price of what you pay. So you could be probably paying the same amount, but what you're paying is going to be going not what it was going to more to your principal, but it's going a lot more to your interest. Going over to the line, lessening the debt before you start seeing the increase. Like I said, this is not going to be astronomical yet, but over time it's going to start hitting your pockets. So go ahead and lessening that debt ratio, and also trying to see if you can lessen the interest rate that you have prior before seeing this uptick. And going over to accumulate. high yield savings accounts is something that I actually refer people to look into, also as CDs, versus the traditional or regular interest rate savings accounts, because you can actually see more gains over time that way. But with the interest rates, federal interest rates seeing an increase, these type of accounts will actually see an increase as well. We saw during this whole panorama that the interest rates were at least over 1% start to trickle down. So when the federal interest rate starts to trickle up, you're going to potentially see the interest rates on these accounts trickle up. Another thing to pay attention to is I want you to start increasing your income. This will help you to kind of counteract what we're going to see when it comes to the gas prices, consumer product goods, and things of that nature. I always say if you're utilizing a 2019 budget in 2022, you're kind of you need to overcorrect that, because a lot of things, the price is, so yesterday's price is not today's price, and we're going to see this even more as we move through 2022. So as we move through this interest and inflation changes, look for a way to CYA if I don't know who's viewing this. CYA, cover your okay. So like I said, this is the first of 5 to 7 that we can see. While it's not a lot, it can eventually impact us, not necessarily this year, but for years to come. So hopefully these tips and insights can give you a way to play through this situation. I have content on my website and content on my social media, so hopefully this helps a little bit more. That's it. Bye.